Hey, this is Courtney Epps here with Outside the Box Business Solutions today, and I just wanted to share a couple things with you today. I'm getting a lot of questions about the new tax code and what changes that has to do with your business and personally, and I just want to help you make sure that you keep and make all of your money with this new tax code. So let's get started. How to get the most out of the new tax law. I'm going to share with you just a little bit of information about myself. My name is Courtney Epps. I am from Greenville, South Carolina. I am a fractional CFO and accountant, and I have been for the last 17 years. I graduated from Coastal Carolina University. I've worked for several large regional CPA firms during and after college, and I specialize in corporate, business, payroll taxes, individual tax returns, and I've owned and operated an insurance agency and accounting firm with over 3,500 clients in Myrtle Beach, South Carolina. Great opportunities to save money here with this new tax code. It's incredible for small businesses. Not all of the savings are going to be automatic though. So there's a lot of things that you're going to have to make changes to in order to make sure that you're getting the most tax savings. And there's some things that you need to know and do right now in order to get those savings. Now, one of the biggest things with a C corporation, and I don't have a lot of clients that have these, but they have lowered the maximum rate of taxes from 35% tax bracket to a flat 21%. Now, if you have a C corporation, this is huge. Like I say, I don't have too many cases where a client should be a C corporation, but here you go. This is a huge tax savings for you. Now, one of the biggest things that has come to attention that is part of the new tax code is this pass-through business entity. So let's talk about the pass-through business entity. S-Corps, LLCs, and sole proprietorships now have an extra deduction that you can take by having one of these pass-through business entities. So if you have business income plus your personal income, that would give you an adjusted gross income. Most people understand that, and that's the way the old tax code worked. Well, now you get to deduct from that adjusted gross income your personal deductions. You also get to deduct the standard or itemized deduction, and then you have a 20% of your net income of a pass-through business. So what that means, if you have $100,000 in taxable income from a business, you can deduct $20,000 of that as an extra deduction. So now you're paying at a lower tax rate usually. Now the game has changed. Rules for what you cannot and can deduct have changed completely. If you don't know the changes, you might not win. But if you learn the new rules, you can reap the rewards. And so let's get into the self-employed. They continue to overpay taxes every year. And so I want you to understand by billions of dollars. So an extra $10,000 in your business could be the determination of whether you're in business or not in the next couple years. So 95% of the people that are paying taxes that are self-employed think that they didn't overpay, but they actually did. So that was a Forbes magazine put that out a couple years back. 95% of business owners, self-employed people, are actually overpaying in taxes. So we want to make sure that you are not doing that. Now, the biggest myth in taxes, I have people tell me all the time, my accountant takes care of my taxes. Well, the problem with that is your accountant is not spending enough time, usually, with your tax return, not because they don't want to, but they're doing 200 to 300 tax returns on average during tax season. Most of that work is done in just 6 weeks. So they're only able to spend roughly 2 hours on each tax return. And the problem is that if it's 2018, I can't really give you advice on what you should have done in 2017 to save you money on taxes. So you must have an accountant, but you have to do your part in making sure that you're getting everything that you need as far as deductions. So you need to understand the difference between filing your taxes and tax planning. They are two completely different things. Tax planning is someone helping you understand the things that you can deduct and the ways in order to do that. You need to understand a little bit about taxes. And knowledge is power. So the more you know, the more savings that you can get on your taxes. Now, here's a couple changes in the personal deductions. So the standard deduction has increased to single is $12,000. It was $6,300. Married is now $24,000. It was $12,000. And the head of household is now $18,000. Some itemized deductions that have decreased or disappeared completely are homeowners now can only deduct the interest that they pay on mortgage debt of up to $750,000. That used to be $1 million. Interest paid on home equity loans will no longer be deductible unless that home equity loan is specifically for increasing the property value of your home. Casualty and theft losses are not included or covered anymore unless they were from a federal disaster. And then you've got job expenses and miscellaneous deductions. And these numbers are huge for some of my clients. So they're not able to do that. So now they have to come up with new ways of being able to write off other things that they're spending money on. Property taxes, state taxes, local taxes. These are now capped at $10,000. So when you add all three of these taxes together, if you had spent $15,000 on taxes, you can now only write off $10,000 of those. Deducting medical expenses. Now, this has actually helped us reduced from 10% of your AGI to 7.5% of your AGI. So if you had $100,000 AGI, which is your adjusted gross income, you have $10,000 of expenses, you're able to take a $2,500 deduction. So that is a really good thing with the new tax code. Now, here's a public service announcement. It's more important than ever to keep good accounting records, and the IRS will likely be watching closer now than ever. The IRS wins 88% of all the audits, and the number one reason is lack of documentation. So what I want to do is also not only give you the information that you need as far as deductions, but I want to make sure that you're covered as far as an audit goes as well. So just make sure you have that backup documentation, mileage logs, receipts, etc. Here's a huge deduction is vehicle deductions. It is insanely profitable deduction. You can save hundreds of thousands of dollars over a lifetime with a vehicle deduction. And there's two ways that you can do that. Now, this has not changed, but there's a couple things that have increased from the vehicle deductions, and you're really going to like them. So one is the standard mileage rate, and two is the actual expenses. So you can take both. Let's talk about standard mileage rate. It is currently at 54.5 cents per mile. It's called the shortcut method. So you can claim mileage instead of claiming the actual expenses. So you don't get to claim gas, oil, repairs, and you don't get to depreciate using the standard mileage rate. So if you had a vehicle that had 15,000 miles for business, very simple, you would times that by 0.545, and that would be $8,175 in deductions. So it's almost never a good idea under the new tax law to take the mileage rate, as before it may have been. Now, it's so much better, and I'll share with you why to do the actual. Now, business usage, you can't necessarily claim 100% of your vehicle unless you actually are using your vehicle 100% of the time. So this is how you determine your mileage, your business use mileage. So you would do the business mileage divided by total mileage, and that is your business use. So let's say you had 8,000 miles, you divide that by 12,000 miles. This is 66% of the time you're using your vehicle for business usage. So on this actual method, if you track your expenses for gas, oil changes, repairs, supplies, car washes, all of those things are actual expenses that you can claim. You multiply that total by the business use percentage. So let's say you had about $12,000 in actual expenses and you had 80% business usage. That would be a $9,600 deduction for you. Now, the depreciation rates have gone up, so you can actually depreciate things faster, which is great. Depreciation subject to luxury limits, you can see here each year. It'll show you the 2017 deduction for that year and the 2018 deduction. Under the old tax law, it would have taken 18 years to depreciate a $50,000 luxury car. The new law allows that same depreciation in 5.3 years. So you get 3 times more depreciation is allowed per year in most years. So you can see here that is a huge, huge tax savings for you. So if you want to go out and buy a luxury vehicle, this is definitely the year to do it. Now, you can legally skirt the rules with a qualified truck, van, or SUV. So I have a lot of people that are asking me, how in the world can I write off my vehicle, 100% of my vehicle this year? Well, you just need to make sure you have a qualified truck, van, or SUV. It allows for you to have a 100% write-off using the Section 179 deduction. And here's an example. So if you had a $50,000 truck, and you used it 90% of the time for business use, that would be $45,000 that you would be able to claim this year as long as you had an income of more than $45,000. So even if you bought it December 31st, 2018, it doesn't matter, you can still claim the deduction. So what does it take to be a qualified truck, van, or SUV? It has to be built on a truck chassis. It has to be new to you, does not have to be a new vehicle. No rear seating for trucks. It has to be at least 6-foot cargo area if it's a truck, and 6,000 pound gross vehicle weight. Those are the things that it has to have. Now, vehicle deductions are the number one audited expense. Both methods require mileage logs. Make sure you keep a mileage log of the date of your trip, the total mileage, the odometer or the address that you're going to, and the description of the business purpose. So it can be audited. Definitely mileage logs are one of the most important things that you can keep, and you need to determine whether something is a business miles or if it is personal miles. Now, couple changes here. Meals and entertainment. Meals can still be deducted up to 50%. But associated entertainment is no longer deductible. So that includes plays, movies, football games, golf. So if you bought season tickets to the Clemson game, you're definitely not going to be able to write those off on your taxes anymore as far as a business expense. So just make sure you know that and you do not claim those. Now, in order to make sure you are audit proof, I want to make sure you understand what you need to deduct meals. There's a couple things, and I just use this and write it on my receipt. Who you met, what type of expense. So we already have that on the receipt. Where did the expense occur? That would be on the receipt. When did it happen? That's also going to be on the receipt. Why? So if you met them for a business lunch, if you met them, to discuss what was going on with a new venture that you had, and how much did it cost? So all of those show up usually on the receipt other than who you met with and why you met with them. So just make sure you keep up with those receipts. There's some really good softwares out there to keep you in check and make sure you have those and don't have to worry about audit time should that arise. Now, official home office deduction. This is potentially much more powerful under the new tax law. The potential to recoup some of the capped property taxes and the mortgage interest on personal returns are huge. So you can actually get some of the deductions that you lost back. I want to share with you how a home office deductions work. You've got your expenses, mortgage interest, utilities, homeowners insurance, depreciation on the home, depreciation on the furniture, alarm systems, all that, and just say 10% of your home is used for business purposes. So that means you've got, at the end of the day, after you've depreciated and taken the expenses, you've got about $2,200 worth of home office deductions. That's about, $8,000 to $1,000 in tax savings, depending on what tax bracket that you're in. Here is a huge tax deduction. This is one of the things that I utilize every single day, is hiring your kids. Kids are expensive. They cost a lot of money. They've got sporting events, dance classes, college. You've got smartphones, video games, weddings, meals. You hire them and they pay for their stuff. So the first $12,000 now with the new standard deduction of their income is tax-free. So that almost doubled with the new tax law because the standard deduction is almost doubled. So you must pay them a reasonable salary, and if your children are under the age of 18, you don't have to pay Social Security, you don't have to pay federal unemployment, state unemployment taxes on them. So at the end of the day, you can literally pay them that $12,000. They don't have to pay taxes on the money. You get to claim it as a business expense. And if they're helping you in your business anyway, you might as well be able to take the massive amount of deductions that you are entitled to for hiring your kids. Now, another tax savings that is huge that I want to share with you is a health reimbursement arrangement, or an HRA. So you can reimburse employees for all medical expenses that are not covered by insurance. So that means you can literally hire your spouse. Now the business can reimburse the spouse's non-covered family medical expenses. By doing that, you potentially get the medical expenses that you are paying and can write them off 100%. So the spouse would pay the bill. You would in turn, through this HRA, pay them back for the expenses that they utilized. Now, do not try to do this on your own. You need a professional administrator, but this is a really good way of saving some tax money. Now, I thought it would be a good idea to share this with you so you could understand exactly an employee versus a business owner, or an employee versus another employee who has a home-based business. So I specialize in small businesses, home-based businesses, and I want to share with you the huge impact that it would be if everyone just went out and had a home-based business on the side and was trying to build that. The massive tax advantages that you would utilize would be so huge. You have an employee who creates the income of $50,000 a year gross. Now, you've got the standard deduction. So if you're single, it's $12,000. If you're married, it's $24,000. You pay taxes on the adjusted gross. So we're going to take the 50 minus 12. That gets us single at $38,000. You're now in a 39.65% tax bracket. That does include FICA, state, and federal taxes. So now your taxes are $15,067. If you're married, you're in a 28.65% tax bracket. You're paying about $7,400 in taxes. So that leaves you with your balance. After that, you've got to pay for living expenses, mileage, vehicle repairs, maintenance, phones, internet, meals, entertainment, childcare, vacations, travel expenses, you name it. So all of that gets deducted from your bring home of $34,933 after your taxes. So at the end of the day, you deduct your living expenses, and you're left as single. You can see on the left is $14,933. Married, you're bringing home $22,551 after all your living expenses. So on the right-hand side is the business owner or the employee who has a small or home-based business. And you start with the same $50,000 a year. You subtract your standard deduction. But the thing is now your living expenses can be redirected as business deductions if you are running a business. So you've got the mileage, the vehicle repair, the maintenance, the phones, the childcare, the travel expenses. All of these are now deducted from your income before taxes are paid. So now you've got an adjusted gross income that's $20,000 lower. Could be more, could be less. Now at single, you've got $18,000 as your adjusted gross income. You're now in a lower tax bracket at 28.65. You're left paying taxes of $5,157. Now at married, you're at $6,000. You're at a 20.65% tax bracket, and you're paying about $1,200 in taxes. So that is a difference, depending on single or married, from $6,000 to $9,000 just by having a home-based business or a small business. So it's just, the tax savings are just huge, guys. So I want to, in summary, just kind of tell you, there has never been a better time for you to start your own home-based business or small business if you don't already have one. If you have a brick and mortar business, and you don't have a home-based business, you are missing out on massive tax deductions. So the business owner's deductions are getting better, and all the other taxpayers are losing deductions, as you can see with the caps and the limits on the home equity line, and the other deductions are going away. Take the deductions that you're entitled to. I have so many people tell me every day that their accountant says they can't write off certain things. There's tax code that tells you what you can and can't write off. And if your accountant tells you that you can't write off home-based business, or you can't write off travel for your business, or you can't write off something for your business, then you may need to find another accountant, because you are entitled to these deductions, and we want to make sure you're getting everything that you can possibly get. Hire your spouse and your kids for additional tax savings, because that can be one of the biggest tax deductions that you can possibly have. And you're paying them anyway, or you're paying for their stuff anyway. And do not do your own taxes. I had 2 clients this year that I went back, they called me and said, hey, how can you beat TurboTax, or how can you beat Tax Act? And I just told them that there was nothing that I could do other than try it. And one, I saved them $4,000 more than what they would have gotten back from another software. And the other one was $19,000 difference. The thing is, they didn't know tax code, and the software is only as good as the information you put in it. And exactly the same thing with an accountant. So the information is only as good to do your tax return as what you give the accountant. So if someone is not there asking the questions that you need them to ask, you're not going to get the tax savings that you're entitled to. So I hope I answered your questions today. I hope this helps you understand the new tax code and things that you need to do personally and for your business in order to go out and have a better and more relaxing, less taxing tax season next year. Thanks.